probably heard fund managers promise to beat the market. They point to their track record as proof they're worth the fees, but how much, if anything at all, should you actually pay for that promise? Active managers aim to deliver what we call alpha. If the stock market returns 8% and a fund returns 10% with similar risk, that's 2% alpha. Although factors such as risk measures and cost are important, most people judge funds purely by performance, how much alpha they generate. Andrew Ng and Debarshi Basu went further and looked at what economists term expected utility. In other words, does the fund truly improve your overall portfolio? Does it offer something different from what you already have? Is it worth the risk and cost? Ng and Basu looked at more than 1,200 U.S. stock funds over a 9-year period from January 2016 to December 2024. The question they asked was this: if you already held a balanced portfolio, say 60% stocks, 40% bonds, would adding an active fund have offered any actual improvement? The results are eye-opening. Only 12% of funds actually improved investor outcomes. For most funds, even those that appear to perform well, the answer was no. They didn't deliver positive utility. And even among those winners, the median benefit was just 0.07%, practically nothing. Here's the kicker. Funds that generated an average alpha of 1.08% were only worth paying 0.19% for. That's about 1/5 of what their performance numbers might suggest. Why? Because most of these funds weren't delivering unique value. They were just riding the same market movements you already had in your portfolio, but charging higher fees for the privilege. This research confirms what decades of evidence has shown. After fees and charges, the vast majority of actively managed funds underperform their benchmark index over the long run. And here's the problem. Identifying in advance which tiny fraction will beat the market is virtually impossible. Even funds with impressive past performance fail to repeat it. The bottom line? That star fund manager with great returns might just be riding the market wave you're already catching and charging you extra for the ride. Studies strongly indicate that for most investors, avoiding active management may better align with their long-term goals. A broadly diversified portfolio of low-cost index funds will likely serve you better, cost you less, and save you the headache of trying to pick tomorrow's winners.